Hey everybody, it's Anthony Meisner,
And Tucker Brock.
and we're here to bring you your lender update for the month. Let's take a look at some August data. We're here sitting in September after the Fed rate cut, and
Good news
so
across the board. We're happy.
I do
Everyone's
say that
happy.
because I think we got to preface with happiness and
Yes.
optimism, right? Now, if we shot this weeks ago, it wouldn't have been that way, so that's why we waited till now.
Yeah, we wanted to be coming out with the most recent information. The Fed making that 50-point basis cut more than expected. It's what, some economists I follow were hoping. But given how slow the Fed had been previously, by the fact of them doing this, you all know,
Mhm.
really good news. Really shows they're taking this seriously, and hopefully this will really start driving down the long-term debt, which it already seems like it has. So great news for you guys. Great news for everybody else. Great news for past clients out there. And just a side note, of course, us at Land Title, we are more than happy to be your title partner for these upcoming refinances. Yeah, we'd love the opportunity to work with you.
Absolutely would. Okay, well, let's get right into the data here. So there's been a 33% increase in active units on the marketplace. That's actually less than would have been expected because about 300 units were pulled off of the market, not under contract, but actually withdrawn last month. So that created a little bit of a dip earlier than expected. Usually we don't see that till September. It happened in July as the peak. So the big thing here is even though the under contract number shows negative year over year, the showing time or the showing traffic data is way up, 18% up. So buyer activity will be increasing, which means since you guys have been doing all this and feeling this, under contracts coming into September are going to be much better.
Yeah, and that's where we saw a little bit of a dip month over month from July into August of under contract and for our actual solds.
Yeah.
Wasn't really expecting that, but I feel like a lot of that was maybe pent up and people kind of waiting for the news that just came out on Wednesday.
All right, so let's talk detached and attached separately, Tucker. You
Yes,
want to touch on the detached market?
I do. And the reason I want to touch on this is looking at our active inventories. Yes, we have 877 across Boulder County year over year. That's 21% up. That's a great sign. But now let's look at our submarkets on this lower left hand corner. Where we can really kind of take a look at where are we getting these increases in inventory. And what's really surprising is we're not seeing it where we might think we'd see it. We're seeing it really month over month from really Superior is the only one. But then if we look at our year to date change, where we're seeing a lot more inventory come in are some of the markets we didn't expect as much, like Louisville. They've had a massive increase in inventory, which is still 46 detached, but
It's a
compared
lot more than
to
they're used to.
last year when it was 23 to 24 was about the average. So we're starting to see that starting to shift here. Same thing in Erie. They've had a really nice increase in their active inventory compared to last year. Same with Lafayette. Boulder's about up as well, similarly. But then we look at places like Longmont, and we can see they're not up as much. And why is that? Well, it's because they've already been more affordable, right? They're not staying on the market as long as your other more
Absolutely.
expensive markets. So where you're shopping still matters a lot. And this is a great slide to show folks going, remember when you looked in Louisville last 2 years ago and there was 6 houses on the market and they all went under contract that weekend? There's 46 right now in the market. These are just nice numbers you can use with your folks.
Yeah, I think the one key thing that we want you to take away today is we want you to help kick buyers off the fence and get them back in the marketplace before, well, everybody else does. So the attached market, the big thing here is inventory's been rising across the board. Boulder is insane, 108% more inventory than this time last year, 277 units in the city of Boulder. It's a lot of inventory. Erie, it shows 100% increase, but it's only 33. So it's a lot. Lafayette's quite a bit as well, 63% more inventory, but it's still getting turnover, still doing okay. Superior, only 9% up, but it saw its rise in inventory last year. And now there's a lot of new construction that isn't in our data here. So when you see that, that's also competing in the marketplace there. Now, the big thing is, what does that even mean, right? Month supply of inventory is probably a little bit easier to gauge. Like, it's going to feel like what nationally we would call a balanced market, but with so much sitting on the sidelines, it probably feels like a buyer's market through most of these markets, right? It might feel more balanced in places like Louisville, Lafayette, Niwot, Erie, Longmont, right? Because that's going to be where it's more reasonable. But
Mm-hmm.
you get into Boulder,
And a
we want
lot
to
of
watch
it's
out.
also going to be by price band. But let's go ahead and take a look at that month supply of inventory, right? And that's just the relationship between if no other homes came on the market
Mhm.
with our current demand, how long would it take to run out of homes or to sell all the homes? And that's where we can see Boulder, the city of Boulder, once again is leading the charge at 5.5. That's much higher. Why? The price point's much higher. There's a smaller buyer
Well, sure.
pool for that price point. And then
Exactly.
we look over to Lafayette, hey, that's always been a faster market. They're still sitting at 2.7. So
It's really, yeah, really
there's
good.
still a really good opportunity for buyers out there to be getting in and getting the concessions. Your 2-1 buy downs, if you're still using those, are still
Yeah, I think
able to
those are going
get
to start
those.
to shrink here going into the fourth quarter, which is very absolutely contradictory to what we've seen in years past.
But we'll see concessions other ways.
Totally. All right, so take a look at this one. This is days in MLS. We see a huge increase in days in MLS. So it's taking longer to get stuff under contract, but as more buyers into the marketplace, this may not stay here, right?
Yeah.
This might have been a little bit of a blip that we don't normally see, or it might kind of plateau out for the rest of the year, which is very common when you see increasing demand in a marketplace. In 2020, that was the last year we've seen increasing demand as the year went on. And look what happened there. We peaked and then we just kind of carried on the rest of the year.
Yep.
That could easily be what we're going to experience because with a rate point or a pull point drop over the course of the last basically 4 or 5 months, I mean, we really are in a much bigger position. The Fed rate cut, all it's going to do is like alert the public that like
It's good
maybe
national
talk to your
media
lender.
news. It's national media news that's
We need
favorable
it.
for real estate for the first time in 3 years. So thank you,
I know
CNN,
we've been
Fox,
sitting here
whoever it is.
waiting
Thank you.
forever.
Say something nice about why real estate's good. Thank you.
That's right.
But okay, let's
Price
jump
point.
into the price points here for detached. Really, let's start the luxury side. And this is, I think, really key to understand is we had a great month in sales for 3+ million. We had a great month, right? We are all going, woohoo, that's awesome. 12 sold. The issue is that the inventory out there is still so significant. It's not really making a true dent in that 3+ million inventory.
Good news is a lot was withdrawn.
A lot was withdrawn. We're still sitting at 127. So that's still a lot of inventory out there because there's only so many buyers per month that are shopping in that price range. So this is just something to keep an eye on if you're working in that higher end market with your jumbos. Just keep an eye on that. We're still seeing some of those with loans, so they're not all pure cash. Just another tool to knock off. Now let's get into the meat and potatoes, Anthony. What are you seeing?
I think the good news here, this is the good news. The detached single family market in the meat and potatoes is doing better. Right behind Tucker's head there, the year-to-date percentage change numbers are 10 to 30%, right across the board. So the detached market's doing remarkably well. We're really starting to see people re-engage the market and get back out there and buy things. Now, the problem is that is exactly the opposite of what's happening in the attached market. And the attached market's suffering, especially that 600 to a million range. Now, in the affordable price points, especially places like Longmont out in Lafayette, they're doing okay too. You're seeing an increase in buyer activity out there, but luxury in the attached market isn't doing as well, except maybe in the city of Boulder. You can definitely see some cool stuff there.
There is, but it's not as frequent. It's a very unique buyer. It's that lock and leave, different situation.
Yeah, very different situation. So detached, awesome. Attached, starting to struggle. And I think that's one of those
struggling, and they've been sitting a little bit longer. So I think the detached is going to continue to struggle, especially with the recent increases in HOA. So really,
the attached,
help your on the attached side. So really help your folks when they're looking into those attached markets, especially on those HOAs that include the water, include the trash, include all the bells and whistles. Really keep an eye on those and help coach your agents and your buyers on understanding how much that's going to affect their debt to income ratio and how much that's going to take away from their purchasing power on those some expensive, $400 or $500 a month HOAs. And I think that's another reason we're going to continue to see a little bit of a softening in this attached market is those HOA dues are going through the roof, and it's because of insurance.
Absolutely. All right. So what does that mean for inventory and like the actual perspective of your buyers out there? It's going to take like 30-ish days to go under contract for most of your detached single family homes. But the competition levels across the board are way different. The higher the price, the less competitive it's going to get. So there are definitely deals to be had out there. If you got those people kind of sitting on the sidelines going, I'm waiting for a deal. Well, they've already sort of missed that, but they're not quite too late. Right. So in the higher price points in Boulder County, there's still stuff to be had out there. The lower price points, though, you really need to light a fire under those buyers because there's only less than 2 months of inventory under 600,000 and under 800,000. It's only 2.5. These are still sellers markets in a lot of neighborhoods.
Yes, 100%. And this is where when we look to the detached, once again, the exact opposite. We're looking at about 40 plus days to sell your average attached unit in Boulder County right now. It's 40, 45 right now. And that's tough. That's hard to tell people this is what it's going to take. But for the buyers and your clients, this is a great opportunity.
Yeah.
This is fantastic opportunity. People are wanting to get out of it. When you're on the market for 45, 60 days, folks want to sell. Buyers want to buy.
Yeah.
And this is a really nice way to help get your folks in. But looking at that month supply of inventory, when we go over 600,000, ouch.
I mean,
We're at,
opportunity is everywhere for buyers.
yes, especially on those higher end attached units, or not maybe higher end, but more expensive attached units,
I
depending on
mean,
the location.
realistically, 600,000 on up. Now, 600,000 does not seem like higher end attached pricing, but in Boulder County,
It's
some of
not
that's
moving.
even median and it's just not moving. So
Yeah.
there's so much opportunity out there in the attached market. Detached is tight. They are not the same, and it's definitely not the same by city. So as we kind of reiterate that, I think the big thing is what's happening to prices. Prices, this is absolutely probably close to the worst they're going to be.
Mm-hmm.
So when you see these negative numbers right now, this is kind of the valley.
This is right because we follow cycles and we're hitting our bottom of our cycle, right? Because
Yeah.
what rates have finally made this shift, things we've already hit the bottom. So we're going to continue to see an uptick in activity as time goes on, which is going to help move those purchase prices back up. So that's
Yeah.
where we can really look at that TTM change is what we always really like to look at, comparing the last 12 months to the previous 12 months. And we can see we have had some slippage. Erie, Boulder, they're down a little bit. And that's because we're just not getting as many of the 1.5 to 3 million sold. 3 million plus is doing well still. But that 1.5, even 2 million up to that 3, just not as much getting bought and sold in that area.
Yeah, well, then
And that
exactly.
really
You
affects
compare that to a
our
Longmont
averages.
market where they're more median priced homes, they're doing remarkably well. It's probably what's carrying most of the county when you look at appreciation.
Mm-hmm.
I mean, Superior detached at 7% increase, Longmont attached at 5% increase,
Louisville at 12? That's
Yeah,
wild.
I mean, the Louisville at
That's
12 is largely due to a lot of the new build stuff coming back on the market after the Marshall fires. But either way, the stuff in the county is doing good. And I think that's the sign with the detached. The attached, Longmont, affordable price points, still doing well. 3.5%. That's awesome. Lafayette townhouses, right? There's not a lot of condos out there, but 6.5% increase in sales price. So you can see where the affordable stuff is where people are buying. And
Yes.
that's where there's a lot. Now, this tough pill to swallow is stuff like Superior.
And that's a lot of brand new construction coming out.
And it's coming on cheaper than resale.
And it's coming on cheaper than resale, which
tough.
it's tough. I feel for the builders out there. It's tough right now trying to get those to pencil. And so we're really just looking at attached. We're seeing more slippage than we do in detached in the areas that have. And conversely, a lot of areas have actually grown versus attached.
But maybe this is a good opportunity. I mean, if we're talking opportunity, this might be the spot where you could really see some good returns next year. Because if you buy in before interest rates start to fall and then demands really starts to come back, I'm kind of against attached, really, but it's because I don't like HOAs. But in this case, I think this could be a really big opportunity.
Absolutely.
All right, so let's get into the sold units. Detached sold units, the first 5 months looked amazing. The next few months looked not bad, but they're really similar. We're up 14% in year-to-date sales. We are going to outperform the rest of the year, most likely, because of buyer activity coming back to market. So September should look a lot like August. October, probably a lot like August and September. And we should just, we're not going to hit the trough like we hit because people aren't just walking away. They're excited because interest rates are better and you're going to go get them engaged.
The one caveat to this is the political cycle and the election. Mm-hmm. That also throws people for a loop sometimes on their behaviors.
Sometimes they're a little delayed.
Getting a little closer. So we might see some kind of bump right after November or nothing changes. It's kind of TBD. But looking at the sold data, I really believe we're going to see really strong sales data coming through for the rest of the year. We're really going to see this
flat plateau looking stuff.
Yeah,
right?
We're not going to have this normal seasonality dip because we're already out of normal seasonality. Now we get to attached.
This is just. We should have just deleted the slide, but we should talk. We need to talk. The problem is it doesn't follow the same seasonality as the detached market, so you don't see these big swings between January and May. But what you are going to see is you're going to see a rough fourth quarter. Because the fourth quarter here was not bad last year, but as we've had more and more and more inventory on the market and more problems, it's been harder to sell them. And the sales volume is just compressed. We were 6% off year to date for total sales volume. It's going to stay tough.
Yeah. And really because, hey, if monthly payment wise, they're pretty similar between attached and detached.
You buy detached.
A lot of folks will go with that detached and give up either location or, maybe quality.
I think it's because of the uncertainty, right?
Yeah, it's that uncertainty. And, I've said this for a while. Detached in Boulder County is the gold standard. Not getting more of it.
It's totally.
Yeah.
All right, so look at list of sale price. The one thing here, we're at 97.6%. that's one of the lower numbers we've seen in a very long time. But the big thing is it doesn't take into account price drops or concessions. And with inventory as high as it is, you are seeing some of both of those. Now, as buyers come back, the concessions disappear before this changes,
Yes.
right? So the issue is this graph doesn't give you enough information to make the full picture. So don't just be sending this stuff off to people.
But it does show relatively where's the competition in the market. And once again,
Totally. And what
it's
should
really
you
by
expect
price
when you
point.
make an offer, right? That's
Yeah.
what this is good for. So depending on price point, like if you're making a detached single family home $600,000 to $800,000 offer, you got to know that hey, we got to come in close to asking price
Right.
because it's still really competitive there.
And
So it's
that's
really good for that.
and that's what several slides before this have shown.
Mm-hmm.
So really use it for that. And the attached side, we can see that definitely again, once again,
Under
under
six
that
hundred
under
thousand.
that 600,000, it's more competitive. Once we kind of get over that 600,000, we start dropping off pretty significantly, pretty quickly as we go up in the price bands. Especially when we hit that luxury at 96, that's not showing any of the concessions coming in on those. And so,
Exactly.
and there's only a handful of those. So that's a little bit more smaller sample size. So just keep that in mind. Disclaimers, and because local matters. And guess what? Land title's local.
We are.
Um,
And don't forget, we would love to work with you in the upcoming year. So hopefully you're enjoying the updates. Tucker and I love putting them together. We really appreciate you, and we'll see you next time.
Take care. Go Buffs.